we're going to talk a lot about the CPO to CFO conversations. Sometimes we think we're speaking from two different languages when we're talking with the CFO to the CPO, CPO to CFO, trying to talk about our initiatives. This is going to be talking about how do we bridge the gap. And so we have a fabulous panel that's going to talk about it. And then I have Lease Accelerator, who's going to facilitate this. And while people think leases, oh my God, that's so boring, let me tell you, you don't know what you don't know, and you better pay attention. Because a lot of stuff is going on, and us, as CPOs and procurement professionals, need to know this stuff. It's really, really important. And we can either make ourselves look good or make ourselves look really bad by not paying attention. So we're going to spend a little bit of time on the leases, then we're going to just talk about how do we bridge the gap. So I want to invite up our facilitator for today. It's Steve Kiefer, Vice President of Marketing for Lease Accelerator. Over 20 years of experience in procurement, supply chain, and financial sectors at various technology companies. And now he's with Lease Accelerator, and I'm so excited because he's passionate about the subject. So I'm going to hand it off to you.
Thank you, Dawn. Thanks, Dawn. So I am a seahorse. I admit it, and this is my first time at SIG. I actually have been in the supply chain and procurement space for about 20 years now, but first time to attend a SIG event. So it's great to be here. I'm based in the Washington, D.C. area, and on my flight out here I was actually thinking about what drew me to get into the space originally. And I was thinking back to 1999 when I first started doing some of this stuff. And it was really a lot of the technology and innovation and disruption that attracted me to it at the time. For those of you that can remember that far back, you think back to late 1999, it was a pretty interesting time to be in this space, right? We had Commerce One and Ariba running around, taking over the world, convincing everyone to buy their first e-procurement suite. And we had all these online marketplaces like Free Markets and Transora and Covicent and 1,600 online marketplaces that were bringing buyers and suppliers together in new ways electronically with reverse auctions and ERFPs and promising to change the world of procurement forever. Right? And as I went to sessions yesterday, I don't think I went to one where the topic of technology didn't come up. AI, RPA, blockchain, which isn't really a surprise to us these days, right? Because technology is so pervasive in our everyday lives and so pervasive in every different dimension of business that we almost expect it to come up in every conversation. We expect the technology companies to be the dominant ones driving the world forward. But 20 years ago, that wasn't necessarily the case. Back in 1999, even though the internet was really taking off back then. Here's a trivia question for you. Every year, there's a lot of these big magazine publications like Forbes and Fortune and Fast Company. They do these studies where they ask companies, you know, who are the most innovative companies in the world? Who do you think held Fortune magazine's most innovative company of the world title in 1999? I'll give you a hint. This same company had that title for 6 years in a row, from 1996 through 2001. Now, most of you are probably thinking, well, that was back in the dot-com bubble, so it had to be eBay or Amazon or maybe a more established company at the time like Dell or Microsoft or Cisco. But it actually wasn't a tech company. So they had to be doing something pretty special to have that crown for 6 years with all the innovation and disruption that was going on. Now, it turns out that this particular company I'm referring to was doing something very innovative and creative, but it wasn't in the area of product development. It was in the area of accounting. This company was Enron, and they had managed to pull off one of the largest financial accounting frauds in history. And that led to some pretty big changes in regulations. So after Enron collapsed, WorldCom and a number of other companies had to restate their financial results. Congress got involved. There are all kinds of shenanigans going on. Enron declared bankruptcy shortly thereafter. A few months later, their executives were paraded in front of Congress and eventually sentenced to prison terms. The company was systematically dismantled. All the assets were sold off to different groups. And Congress started a pretty heavy research effort into what had gone wrong with public accounting and looking into how things could improve. And so there were all kinds of fun new regulations like Sarbanes-Oxley that came out and all kinds of new government agencies that were created. But one of the things that didn't get a lot of attention in the media, and you guys probably haven't heard as much about, is the accounting boards actually went back and looked and did some analysis at how did Enron and WorldCom and all these things sort of come to be? And what were the loopholes and the strategies that they were using? And how could we close those so that this sort of thing wouldn't happen again? One of the techniques that Enron had been using was they had taken a lot of the liabilities and ugly stuff in their financial statements and managed to push it off into these special purpose entities, as they called them, which were offshore companies largely that they wouldn't have to include in their financial statements they shared with Wall Street and investors. And as it turned out, when the SEC and Congress did their investigation, they found that there was another category of off-balance sheet liabilities that was in the trillions of dollars, and that was the area of leases. Now, it was perfectly legitimate and acceptable to not put leases on the balance sheet according to the accounting rules, but the SEC and others thought, well, it's a little bit misleading given that there's this much sort of debt out there and it's not front and center on the balance sheet. It's typically reported in a footnote, but most people don't scroll down to page 143 or 151 of your annual report when they're making investment decisions. If anybody's read an SEC filing, we all know it's not the most interesting reading. So they set about to try to close this loophole and make some changes in the way that leases were accounted for. It took them 17 years to get these new accounting policies in place, and they took effect on January 1st of this year, 2019. For the first time, we started seeing public companies start to report leases on their balance sheet for the first time. And over the past 10 months, we've seen a couple $1 trillion worth of leases come on to corporate balance sheets in what many people would call the biggest accounting change that has ever occurred. Now, most of you in the room have probably not given a lot of thought to what do you lease or how it's accounted for. And what you lease probably depends a lot about your credit rating and how you think about cash flow, and also to some extent what industry you're in. Those of you that are in the retail space or hospitality or professional services, you're probably leasing a lot of real estate, land, buildings, things of that nature. If you're a more asset-intensive industry like telecom or transportation or utilities or oil and gas or discrete or process manufacturing, you probably have a more diverse mix of things that you might lease, which might include fleets of vehicles, rail cars, trucks, marine vessels that you're using to move raw materials and finished goods around your supply chain. Maybe you lease a little bit of IT equipment, office equipment, things like the photocopiers in the break room, maybe even the furniture, desk and table that you're sitting at every day. And you think about your business and all the assets that are used to run it on a day-to-day basis, a better question might not be what do you lease, but what do you actually own? When you think about business process functions that are outsourced and the number of service contracts that you have with various different vendors that are using assets that are critical to your business but you don't necessarily hold the title or own. How many of you in the room actually own the servers that your ERP system is running on? I bet a lot of companies are running them in the cloud. How many people have a perpetual license to the sourcing and procurement software that your teams use to run their day-to-day operations? Again, I bet a lot of people are switching or have switched to software as a service models. And there's 10,000 engineers that are a couple hours north of here in Silicon Valley that are on a mission to turn every product into a service, because Sand Hill Road and Wall Street has fallen in love with recurring revenue models. They don't want you to buy anything. They want you to rent it and pay them a subscription fee in perpetuity. So we might be sitting here in 20 years talking about the good old days when procurement organizations used to be able to buy stuff because by then we may be forced to rent or subscribe or buy it or consume it as a service, right? Now, I can see some skepticism in the front couple rows here. People are kind of scratching their head going, but yeah, when I use the cloud or I buy software as a subscription, that's not really a lease, is it? And that's a great question, because that's where this accounting change gets really interesting. There are a lot of gray areas. So the accountants think about leases differently. A contract doesn't have to have the word lease at the top of it or anywhere in the document for it to be considered a lease from an accounting standpoint. So things that a banker or a lawyer might not call a lease, an accountant would. So for example, under these new accounting rules, it's possible that if you outsource your production to a contract manufacturing company, that the factory or some of the machinery that's in the production line or the land or other assets that are bundled into that contract could be considered leases. and would be put on your balance sheet as a liability. It's possible that if you're using a third-party logistics company, that some of the trucks and the forklifts and the warehouse buildings that are in those contracts could be considered leases by accountants and moved on balance sheet. If you outsource different parts of your IT, the data centers that the servers are running in, the storage devices, the networking equipment, the power supply units could be considered leases from an accounting standpoint. Same thing with power purchase agreements, advertising signage, Bloomberg terminals that you might be using to make stock trades, DirecTV, set-top boxes that might be sitting in retail stores or at your corporate headquarters location in the lobby playing CNN or other things that for visitors. All these things could potentially be considered leases. So here's where you guys come in. The accountants need your help when we sign new outsourcing and service contracts as well as leases. They need to collaborate with the procurement team to interpret those contracts, which, as you know, some of which are very sophisticated and can't just be handed over to a junior staff accountant to try to interpret and understand. And there's an opportunity to not only help the accounting team comply with these new standards, but also to potentially get some of these things off the balance sheet, because depending upon how you write the contract, some slight changes in the terminology and the wording can help keep some of those liabilities off the balance sheet. Another area that the accountants really need help with is tracking these leases and contracts throughout their life cycle. So if you think about a company, say for example, that has 1,000 different leasing contracts, maybe the average term of those contracts is 4 years. So that means every year, 25% of the contracts are coming to the end of term. Things are coming off lease. Presumably, you're using those assets for something, so you're probably going to want to replace them. So you've got 25% coming off lease and another 25% new leases. So that's 50% of the contract population that's changing every year. Even things that are in the middle of the contract might have changes to the rent or the pricing. You might make modifications to add or drop assets to them. So we find on average about 60% of a company's lease portfolio changes every year. And there may be accounting ramifications for those things. So procurement is in a really good opportunity to help your peers in the accounting group track some of these things to the extent that you're involved in negotiating new contracts or renewals or modifications to them. Now, there's nothing like talking about leasing and accounting to wake people up in the morning as an opening session. I know this is exciting stuff. But the good news is we're done talking about the leasing stuff, and we're going to broaden the conversation a little bit because this panel is really going to be about how can procurement better collaborate and work with their peers in other parts of the CFO organization, whether that's finance, whether that's accounting, whether it's treasury, and get better aligned. And we thought this lease accounting change was a good example of where there's a lot of intersection and overlap between the things that procurement organizations are doing and the things that our accounting are doing. So we thought this would be a good way to kick it off. So at this point, I'm going to ask Tom and Joseph to join us up on the stage, and we will move into the panel part of this session. Okay, great. Well, why don't we take just a minute to do quick introductions here. I know those of you in the room that were out on the golf course yesterday may not have met Dawn, but maybe, you probably know her well. But maybe you could spend a minute just talking about why we added you to the panel, because you have an interesting background. I think people think of you as a procurement person.
Yeah. So I actually am a closet bean counter, a recovering CPA. I had private practice in Silicon Valley for about 12 years, working with early stage startups like Electronic Arts and companies like that, Hewlett-Packard in the early days. That's how old I am. Then I was brought in to build a cost model for someone who was doing strategic sourcing but couldn't prove their value. So they hired my firm, and I fell in love with sourcing. So I sold my CPA firm, and I went into sourcing consulting. And then another 12 years later, I had the opportunity to take over SIG. So at the end of the day, as much as I try and shed it, I love Excel spreadsheets and I love numbers. But I also learned that I had to learn to love people as well to be able to be good at sourcing. So I've come a whole way, and this stuff is really exciting to me. I'm embarrassed to say.
Good. Tom, you want to introduce yourself?
Good morning,
quickly?
Tom Lutz. Been the CPO at U.S. Bank for a little over 11 years. Prior to that, 20 years at General Mills, and first in an IT role. Then moving from that, I was a commodity trader for General Mills, moving then into procurement supply chain. Spent a few years in the home building business, but really privileged to be here. Enjoy this a lot. It's fascinating. The procurement profession itself, as you all know, is a great place to be in an organization, and happy to be here and be up here with fine folks, and really have enjoyed getting to know Joseph a little bit.
Thank you, Tom. My name is Joseph Martinez. I am the Chief Procurement Officer for Bank of New York Mellon. I've been there for about 6 months now. Prior to that, I've had a series of CPO roles in a number of global banks. In my last role, I was both a CPO and a CFO, so I think that'll be relevant to what we're doing today. In my career, which unfortunately spans almost 30 years, actually more than 30 years, I've had 3 different lives. I was an officer in the U.S. Army, I was a consultant with PricewaterhouseCoopers, and then I've worked in financial services and supply chain.
So Thomas, before we get into it, I have an interesting fact. So Steve Kuiper, you are Steve Kuiper the first?
Yes, as far as I know.
Yeah?
Yeah.
Okay. Tom?
I'm the 9th.
Thomas Lutz the 9th.
Yep.
Joseph?
I'm Joseph Francis Martinez the 22nd.
Wow.
These two just had an epiphany at breakfast. They were like, something about, you go by Joe? And he said, always Joseph. And he said, I'm Joseph Francis Martinez, this is 22nd. And Tom goes, I'm the 9th, my son's the 10th. No one ever beats us. No one. So we're just number ones.
Yeah, I don't feel special at all.
I don't either. But I just thought that was an interesting fact. So now when you see Joseph, you're going to think 22, and you see Tom, you're going to think 9, and you're going to think, wow. Wow.
I mean, Joseph shared, that's 1301. You think about it, that's amazing.
That's
history.
amazing.
That's amazing.
Yeah. He also said his family lacked imagination. So they were all Joseph Francis Martinez, but yeah. Anyways, I didn't want to sidetrack you, but I did, so sorry.
Sorry. So let's talk about finance and procurement and the different perspectives they have. So Tom, why don't you start us off? One of the things that I've definitely observed when we were chatting, financial professionals tend to take a very numbers kind of driven, black and white type of approach to decision making, which is a little different than the way procurement folks think about things. Can you kind of share your perspective on how procurement and finance sort of see the world through different lenses and some of your experiences?
Yeah, I think I would summarize it as, I think procurement folks are a balance of both qualitative and quantitative, and my CFO would lean very much towards quantitative. And I was thinking of an example. I had an experience with our CFO years ago, and my team and I had spent several months working with our retail branch environment and with our properties folks to improve the remodeling and the building of branches that are found in grocery stores, on college campuses, sometimes on corporate campuses, and U.S. Bank has about 700 of those across the country. So after about 3 months of effort, we concluded the project, reviewed the results, and I sat down with the CFO, and in my monthly time together, he wanted to know where projects were, what was accomplished, and what was saved. And I was reviewing for him, I mentioned the branch project, the remodel, and how we made it better. And he basically, what he wanted to know was, what did we spend per square foot before you started, and how much had we improved that and reduced that expense? And we had made some improvement there, but it was marginal. It was maybe 3 to 5%. And he looked at me, I think there was a hint of disdain and like, was the juice really worth the squeeze? And I said, however, let me talk to you about the other things that were made better. I said, the quality of the construction was improved. the adherence to brand standards across the bank was improved, and we reduced the construction cycle time by 2 weeks, which means you can open up that branch 2 weeks sooner than the business case originally warranted. And all of a sudden, the conversation took a whole nother turn, because we all know procurement is not just about savings, which is where they want to go, and we all understand why the CFO wants to go there, but it really is about driving value. And that value can show up in a lot of other places. And of course, every one of those has value. I mean, that's why we spend money on our brands. We open something 2 weeks sooner, we're going to enjoy improved revenue, et cetera. But I think that illustrates the healthy tension that exists between a CFO and their look at the world and the responsibilities that they have with Wall Street. And we as procurement professionals have to constantly work to keep that lens a bit wider.
Great. Joseph, you have a unique perspective on this, because as I understand your last role, you actually were the CPO and the CFO at MUFG. Can you share with us some of the things that you did to sort of bring those organizations together, and some of the optimization opportunities that you were able to create?
Yes, certainly. So one of the things that we traditionally don't think about is what we do in procurement essentially is we're looking at the non-comp cost categories. And so that's kind of the space that we play in, which ultimately is going to be 1/2 of the cost to income ratio. Now, while we can help to put in place a perspective that will help the sales forces increase the sales, at the end of the day, we really need to be working across the businesses impacting that cost basis. And in order to do that, you need to be able to see it. You know, if you can't see it, you can't measure it. If you can't measure it, believe there's not a lot of value that's going to be derived. So one of the things that we looked at was saying, okay, how do we actually create transparency from the cost-based perspective? And so we went in and we implemented essentially a taxonomy that enabled us to work 4 levels beneath the general ledger. We tied it to our source systems. And so we were looking at that as a way to create transparency from a cost basis perspective. But the ancillary benefits that came from that were, because once you have the cost decomposed appropriately, it's going to reduce the number of journal entries that you're going to have to do from an accounting perspective. It's going to help you with your forecasting. It's going to allow you to do plan adjustments. And it's ultimately, from a finance planning perspective, as well as from the controller's perspective, you're actually going to decrease the cycle time that it's going to take to close your books. It's going to give you a better perspective relative to how you're actually impacting the cost base, and it's going to allow you to optimize that force. And in some instances, we were able to actually introduce robotics process automation, where, because we now had standard classification for how we were actually decomposing our spend, and that enabled us to reduce the number of headcount that we had in some of our middle and back office finance functions. So there's a direct correlation because of the stuff that we do in partnership with the other parts of finance. And so it's a unique way of looking at things, but frankly, I think it's the way that we're going. And everybody talks about how AI and RPA are going to impact us. Well, this is one way that you can start to see the benefits, where it's basically you're working across the entire stack, and you're optimizing that. But it all started with an engagement where we wanted to really optimize the cost base so that we could go out and make better markets and better events from a competitive perspective. But it ultimately allowed us to actually pull that through the financials in a much more seamless manner.
Great. Thank you. So Don, you've had an interesting journey, starting off as a CPA earlier in your career and running the practice, and then spending so much time with procurement professionals. What are some of your observations about the differences in the mindset and how the two different groups kind of think about value and the importance to the business?
So I have to be honest with you. When I first started, I was brought in to build a total cost of ownership cost model, and I realized that I am very black and white. As an accountant, everything had to balance, to the penny, and numbers told the story. And I just remember the first time when we had done our analysis on all the suppliers, and we hold it up and say, well, obviously we're going with this supplier because it lowers total cost of ownership. Great quality was the same across the board, everything. And I got pushback, and they said, well, what about that we're not sure we want to switch, to a new supplier, and I'm not sure the nurses, this is at Kaiser Permanente, I'm not sure the nurses really, are going to appreciate those changes, and how do we educate? And it's like, guys, it's right here. It's black and white. There's no, and to me, I was incredulous. Like, I started to think, like, are you that dense? And it's right here. And thank goodness, I had a mentor who had a PhD in organization development, Miko Banfield, who worked at Southern California Edison, who was my lifelong mentor. And she said, Dawn, it's about the people. And I said, no, it's about the bottom line. Because that was what my entire brain was focusing on that. And she said, it's about the people. You can source anything, make any decision you want, but if people don't buy off contract, what good is it? And it was so eye-opening. Like, the first time I had to go and they brought in a change management consultant, I went, oh, please. I felt like this was like a hippie thing. Like, this is so stupid. And so it took me, I would say, a solid 6 months to a year to let go of black and white and see shades of gray. And those shades of gray is our ability to sell, our ability to lead within the organization, our ability to get people to want to follow us, ability to get people to believe in what we were doing. And it was an epiphany for me. And it completely changed, where I started putting the people first, and I listened to every yeah, but, which is the favorite, people's favorite comment to procurement. Yeah, but you don't understand. Yeah, but we're different. Yeah, but you've never sourced this before. Yeah, but. And I learned that every yeah, but had to be addressed, because there's all this background noise that is going on in people's heads. So even if they don't say it to you, they're thinking it about you and about what you're recommending. And if you've got to get all that background noise out, and then you get down to everyone can come together and sing Kumbaya. So it was an epiphany for me. And thank God I made it to the other side. Otherwise, I'd be still that black and white bean counter and boring as heck and have no friends. But it just changed the way I approach the world. And so I fell in love with sourcing because I realized it is all about the people. It is about the tremendous amount of change that we can make. So know that a lot of your CFOs that you report to are still stuck in that it's all about the numbers, because that is such a comfortable place to be if you're a bean counter, because it balances. And so I think trying to get them to realize about all the people, processes, and changes that we have to make are monumental. Like you said, all the improvements we made that may not be in the bottom line, but it changes people's work and their relationships to how they work. It's a different conversation. So I think we have to, you have to work with these people that are like me, how I was, and help them see the people side, the change management side, they don't have any EQ. So you have to teach them EQ. None of them, but most of it, I didn't.
Okay. So Joseph, another question for you. So you've been both a CFO and a CPO. What advice could you offer the audience as procurement leaders in their organizations when they come talk to a CFO? How can they change their terminology and perspective? How can they communicate better what their strategies are and the rationale for the types of decisions they're making? Any advice or suggestions?
Well, I think you have to lead with a fact base, and you better really understand what your costs look like. But it's not just about that. You need to be able to go in there and say, okay, how do I actually, if I make an improvement and I'm able to trace that back to an earnings per share perspective, that's what they care about. They want to actually understand what is the true impact that you're doing. And one of the things that I would never lead with is cost avoidance. I think that's an interesting metric that is best left at the door. Talk about, if they're wanting to talk about cost, you want to look at the P&L cost reductions. You want to take a look at the project cost reductions. You want to take a look at the one-time saves, because those are all tangible. The cost avoidance is an interesting metric, but it's not really valuable, and what it actually does, I think, is it erodes credibility relative to the good work that we're doing. It's important, but it's not something that the CFO is going to really care about, to be candid with you. In addition to that, you need to make sure that you're understanding that whatever strategy you're putting in place, and they need to be able to pull that through to the strategy of the business. So what you're doing has to be downstream of whatever the business strategies are. And so that I think is something that we have to do a better job of communicating what we're doing with the CFOs. And so I'll give you an example. If, for instance, you have a time to market issue within a particular new product or service that you're going to be putting into the market. And let's say that beneath that, you're working with a marketing organization, and they're trying to get something on, let's say, November the 1st. This can be their launch date. If they come to procurement, and procurement is working, and they're saying, well, great, I'm going to go out there and get some printed material for this, and they get the lowest price for that, but it doesn't deliver until the 3rd of November, then your strategy is misaligned with the strategy of the business. So it should have been a surety of supply, not lowest price. And so you need to think about when you're working with the CFO and with the other executives, what is the strategy that the business has, and then take a look at your category strategies and take a look at what you're actually doing in order to be able to drive that. Show them the value. Be concise. Go in there rather than with PowerPoint. Go in there and show them actually, what it is that you're doing from a numbers perspective, which I think is important. And, respect the fact that they're not going to be subject matter experts. So if you go in there talking to them in procurement speak, you're going to talk right past them. You have to go in there and actually speak to them in the language of finance. And it's all encompassed upon us. One of the things that I did, and what I'm doing where I'm currently at, is we're going to be sending our teams through the SIG Certified Sourcing Professional Program. And it has a couple of modules in there around finance. I think it's important that all of your teams actually get that type of training, specifically so that they have the ability to work across the organization with the finance and speak to them in the language of finance. Because if you can't do that, it's really going to be difficult for you to be successful. Hopefully I answered your question.
Yep.
But doesn't that play just into exactly what you said, is that now you're suddenly putting leases on the balance sheet, which doesn't mean a lot to a lot of people here, but it means that you're recording an asset and a liability, which completely changes a company's financial picture to the market. And that's the part that, they have to get comfortable with balance sheets and income statements and GLs and all of that stuff, even though it sounds really boring, but we're impacting it. So.
Yeah, absolutely. So next question I'll open up to just to all three of you. You guys have had a very diverse range of experiences: General Mills, U.S. Bank, MUFG, Bank of New York Mellon. Don, you get to work with all the audience members in a variety of different ways. Any examples of companies that you think are doing this right, where they've really kind of figured out how to get finance and procurement collaborating, communicating together, or getting one side educated better about the others? Or maybe other people in your network that you've heard that do it well? Any success stories you want to share?
Steve, I don't know that I would know enough to say finance and procurement, but when I look at a model that we would aspire to as an organization in terms of getting the customer experience right and letting the profitability from that right experience then drive the right behavior, I look at Apple.
Okay.
And the fact that, they have figured out what is it worth to please the customer. And when you go in an Apple store, you think about the experience that you have when you use their products. They're certainly not the least expensive, right? And yet, we would say from a value perspective, the empirical evidence indicates they're getting it right. And I think that they, as an organization, have established a culture that gets everybody aligned with that mission. And I think we as procurement leaders find our success when we can figure out how to tie our procurement organizations into that organizational mission. And that takes a lot of time and talent, but I think that's what makes the job so interesting. A lot of people have what they think is a qualitative view of things. It turns out those things can be quantified. It's a matter of helping them understand how to quantify, well, what is it about that supplier that they like? What is it about that experience that they like? What value drives from that engagement? And how ultimately does that engagement get monetized? And so I think of Apple when I think of a model of an organization that does that pretty well, pretty consistently for a long time, even given the significant transition to Tim Cook.
Yeah. Great.
I, like you, will kind of play upon the Apple. Specifically, when you think about it, Tim Cook used to be the CPO at Apple. So one of our own actually made it to the C-suite, right? And so I do think that really shows that if you're able to actually have a broad array of roles and responsibilities in your career, you have the ability to kind of go up. Honestly, when I'm looking at it across other companies, to your point, I don't have enough of a point of view to where I'd be able to really opine. I've seen some efficient and I think effective supply chains out there, but not one where I can just raise my hand, unless it's an organization that I've worked in, because what you see from the outside versus what you experience on the inside is typically very different. And so I think we as an organization we as a profession are somewhat nascent in terms of what we're doing to actually be more effective and efficient within our organizations. And now, we've been doing this as a profession, a real profession, probably for about 35 years, right? But you're now starting to see that with the education systems that are out there. I'll give you an example. If you look at what ASU or NC State or Michigan are doing, they're actually morphing what it is to get a supply chain degree. They're starting to actually inject in their risk management. They're injecting in their data analytics. So they have to take data science classes in order to meet the curriculum. So I think that those are things that are eventually going to help morph what we are into probably something that we can't even imagine today. So if you go back, 35, 40 years, it was an operations degree, which now is becoming a supply chain degree. So I do think that there's that opportunity from an industry perspective, and I think it's incumbent upon us who are CPOs to work with our teams and to help drive them, okay? Because if we don't help to morph what the future is going to look like, and we have to be early adopters, and we have to be able to fail fast and move on, because you just are not going to be able to make changes if you're afraid to fail. So I can't really opine upon others, but that's my view.
Dawn, any
I would say from my experiences within SIG, I would say one that stands out, and she actually was inducted into the SIG Hall of Fame, was Debbie Manos McHenry, who was at Huntington Bank. She was a CPA. She helped write a lot of our curriculum for SIG University, and she got the CFO talk. And now she's gone on from CPO to a vice president of operations, but she was one that just always could translate. And by the way, if you're not linked in with her, if you're not linked in with these guys, link in with them, because as mentors, she would sit down with people and say, you're not speaking the right talk. And she never hesitated to call you out on it. And she has mentored so many people within SIG, as these two have as well, just to help us with the language. So she stood out for me because we were fellow bean counters, and so I was attracted to that. But she also then started to mentor other procurement people, so it was really a wonderful relationship with her.
That's great. Good. So last question open to anyone. Any additional kind of words of wisdom, lessons learned, best practices that you want to share with the audience about how to work with the CFO or the finance organization?
I'm going to give just one. Try and train your staff that $1 is not $1. That a capital dollar is not the same as an operating and maintenance dollar. And so if you're working for a business unit and their drive is to reduce capital, and you keep bringing them sourcing initiatives that are going to reduce their O&M, you're not going to be successful. And vice versa. If they've got to reduce their annual O&M expenses and you're bringing them capital projects, you're not delivering. So $1 is not equal to another dollar when it gets to their budgets and the CFO. And we've got to train our staff to understand the difference of the dollars. So that would be my first takeaway. If people understand the difference between those two type of categories, you don't know if you're being successful. You don't know if I'm making my business unit successful.
I think the piece that I think about here when we have this conversation is talent, right? And so I think what we look for in the marketplace today to hire has a different skill set and a different experience set than maybe 5, 10 years ago. And looking for people not necessarily with traditional procurement experience, but understanding value, understanding the importance of, really serving as a bridge between a business line, an operating unit, and a CFO when it comes to vendors and being innovative and being agile. That's a different skill set. And so we're constantly looking at being more inclusive, more diverse in terms of both professional experience, educational background, et cetera, because we found that we as a procurement organization have benefited from moving beyond maybe some more traditional recruiting that we've done.
Great. When I look at it, I'm saying we have to really think about how we're going to actually impact the growth of the business. And in order for us to impact the growth of the business, we actually need to make sure that we're looking at not just the cost, but the risk. The risk is becoming more and more crucial. You know, as we take a look at the regulatory environments across, whether it's pharma, financial services, insurance, third-party risk management is becoming an extremely important component of all of our organizations. And so making sure that we are helping to optimize that process with the procurement process, with the finance process, all in alignment for what we're trying to do with helping to grow, to help our businesses grow. That's what we've got to be thinking about. We've got to think about ourselves as value creators, value enablers. What we can't be seen at are the green eye shade cost guys. That's not going to work. We have to make sure that we're thinking about this holistically. We're having to think about how this is actually going to empower our organizations to actually eke out the competition. I work in financial services. I work for a bank that's been around for 235 years, founded by Alexander Hamilton. That doesn't give us the right to exist for another 5 years. You know, the fintechs that are out there that are coming for us every day, if we don't partner with them and find a way to get them through our risk processes more effectively, they're going to compete against us, and at some point, they're going to supersede us. So, you know, when you look back on Amazon as an example, right? What an industry disruptor they've been. You know, they started out selling books, and now they've essentially gone and in the retail space, they've reinvented what that means. If you take a look at the malls back in the day, they kind of laughed at it. They're now buying malls and turning malls into distribution centers because of the locations that are close to where their customers are. So we got to really think about how do we reinvent ourselves, and I think we have a perfect opportunity from a procurement perspective because we're the folks that are on the front lines working with the suppliers, looking for that innovation. So I think it's really important for us to be able to bring that insight to our finance organizations, to our operations organizations, to our sales organizations, so that we're thinking about this, I think, as business people, not as somebody who's in the middle or back office. That's my point of view.
So do we have time to take a question from the audience?
I was just going to ask whether we had time for that.
So we have a couple microphones. I have one here and one in the back. So come on up, Bree. Oh, now it's your turn.
Yeah, just a quick one.
And you are?
I'm Arif Faruqi from CSA Insurance. We are a triple insurer. Joseph, a question for you, or maybe for the panel as well. You mentioned about the cost avoidance. What's your suggestion or guidance in terms of taking the credit or reporting it the way that it gets CFOs here as well without boring him with it?
Yeah, I think it's an interesting type of save, for lack of a better term, but I don't think you should ever lead with that because the numbers become very large very quickly. And what the CFO is going to care about is what can I actually pull through my P&L and what is actually going to impact the budgets. But you've got to also be very careful that you don't come across as the budget cutter. You need to partner with the businesses so that you're not seen, i.e. procurement is not seen as the folks that are going in there and when they work with us, their budgets get cut. What we have to do is we have to make sure that we have the ability for them to do reinvestment, and we need to make sure that we're putting in place those components. But to answer your question specifically, on the cost avoidance, it's an interesting metric, but nobody believes it. They don't. So that's just my point of view. You can have it out there, but it's something that should be in the appendix. It's not something that you should be leading. So if I'm reporting out, I want to basically show, of the 4, I'm going to put that in the appendix. The 3 that I really want to show are my P&L save, my project save, and my one-time saves, because those are real. Those are things you can touch.
And then we have a question back here in the back. Oh.
Good morning, Linda Tucham, Nontala. I just want to say, first of all, you guys make me feel proud to be part of this profession. What a fantastic panel, thank you. I have a question. Seriously, that's really, I do feel bad. Joseph, I have a question for you. You mentioned about going 4 levels lower than the GL. Could you just talk a little bit about what that means and how you did it?
Yes, certainly. So essentially, when we started to take a look at the non-comp cost categories, what we've done is we've come up with 13 level taxonomy in terms of breadth. So we have group, we have family, we have group, market category, subcategory, and then beneath that we have capabilities. And so what we're doing is, as an example, at the family you have professional services and labor. You come down to a group, okay, and so what you're able to do is you're able to say, well, you know, what do I have here? Do I have consulting services and do I have contingent labor? And then as you take it down, what you're doing is you're looking for opportunities to make sure that you're able to tie it at the highest level back to the GL, because you don't want to create a restatement issue for the CFO. And then you want to be able to tie the taxonomy into your source system so that you're getting it right when you're ingesting it into the supply chain, as opposed to going back and having to restate it and move it around. Because how many of you have had to deal with suspense accounts, right? And what's happening is they're putting cost in there and they're mixing it up. By the time it comes out, it's very opaque in terms of what you're doing, and so you start to lose that transparency. So for us, by putting this in place, what it enables us to be able to do is to be able to say, this is what this cost is, this is the cost category it should go to. By having that subcategory level, it allows me to then start to do risk ratings from a third-party risk management at the subcategory level, so I can reduce the cycle time relative to how I'm actually going to get to market. And then what I'm taking a look at is at the market category. That allows me to make market baskets that I can take out from a competitive perspective. Now, remember, we buy at the capability level, but we actually go to market at the market category name. So for me, it's just a logical way of enabling us to be able to look at our non-comp costs, standardize that, and now you can start to budget effectively. Now you can start to actually do your risk management effectively. Because you're calling an apple, you're not calling an apple a pear. And so, but by doing this, there's a lot of efficiency that you can gain across the supply chain, but it's not easy, okay? And it's something that you also need to have a regimented governance program and process in place for, because the capabilities are going to change on a regular basis. Your subcategories and market categories may change over time. Okay, so as an example, how many of you, if you had a telecom category and you had a mobility component to that, and you look at it at a capability level 15 years ago, we would have had pagers. Nobody has pagers anymore. They have smartphones. So you need to be able to think about how you're going to govern that as you transition it over time. But there's a tremendous amount of efficiency and effectiveness that you can get from that. But all of this is part of a larger program. A taxonomy on its own is useless. You got to make sure that you understand what your processes are across your ecosystem down to a level 4, so that you can make sure that you have your process, you can get your desktop procedures, you can tie that to your policy and your risk and control framework. By doing that, what that enables you to do is to start really thinking about how are you actually going to change the ecosystem in such a manner that it's going to become much more efficient. And I don't know about you, but it's very difficult for me to get new headcount. Okay, so this is a way for me to be actually optimize the headcount that I have. It's a way for me to play bigger with my stakeholders, because they don't want to spend time going through our processes. What they want to do is to get on with the business of banking. So hopefully I answered your question.
We have time for one last question, and it's over here. And I'm sorry, Bree, you two can fight it out. Antonio? But they're going to be around afterwards, so you will get your question answered. See, you guys never thought that this was going to be so exciting when you saw Lease Accelerator in the title.
So the question is, when you're looking, I think, Joseph, just like you alluded to, a lot of us in the procurement function really have this broader business view, capability, insights, and I think we're being tapped to look at broader impacts across controllerships and across the global finance organizations. That's the conversations I'm having right now with my CIO and CFO. Are there things, and this is for everybody, are there specific areas that you're seeing could be focus efficiency areas in part of global finance that we can also be partnering and making some of those impacts as well.
I don't want to hog the mic, but I'll just say really quickly, okay, in our planning and forecasting process, working with the finance planning and accounting groups, there's a tremendous amount of opportunity. We have to streamline that process through some of the actions that we, from a supply chain, are driving. And they're desperate for it because there's our ability to help them essentially do their jobs more effectively, and our ability to bring in machine learning to be able to improve the speed relative to what we're doing, whether it's through a contract process, whether it's through a budgeting process, or using RPA so that because we now have a consistent component, so that we're able to do a lot of the work that they traditionally are throwing bodies at, either onshore or offshore. So I think there's a lot of work that we can do there with looking at it just from an insular finance lens.
Antonio, maybe not from a global finance perspective, but one of the things that we don't practice broadly, but we're trying to practice in some very specific areas as it relates to products driving most of our revenue is zero-based budgeting. And at least in financial institutions, there's not usually a clear picture across an internal and external supply chain as to what your expenses are and what incurs them. And is that truly a consumption model, or is it a license? There's an attributing of cost to products, and oftentimes that relationship is not clear. And we as procurement are now having discussions across those revenue-generating products to understand what all of those relationships are, so that when we talk about our 2020 budget at the business line level, we can understand that if there's revenue growth and volume growth, there can be an associated cost perspective associated with that. And that's not something financial institutions typically do, but we're trying to map that out. And as you might imagine, for those of you that do this today in other disciplines and other industries, you learn a lot about what's working well and what isn't when you discover what those relationships are, because everybody thinks they understand what they are, and yet when you actually look at the products that have evolved and the contracts that have evolved, those relationships and the calibration between your expense and your revenue is sometimes not what you expect it to be. And so that's been a helpful thing for us already.
Well, time is up, but I just want to thank you for bringing this panel together, and it really is something that we need to pay attention to, we need to know about, and I want to thank the two of you, because I just knew that you guys got it and could talk to it and make it exciting and fun. And so with that, I'd like to thank this morning's panel.